There is a number that does not appear in any government budget. It does not show up on any balance sheet that gets reported to the public. It is not discussed in campaign debates, not covered in earnings calls, not mentioned in the annual financial reports that cities and states mail to their residents. And yet this number represents one of the largest financial obligations in the history of the modern world. The number is the true unfunded liability of public pension systems in the United States alone. Depending on whose accounting methodology you use, that number sits somewhere between $4 trillion and $9 trillion. $4 trillion on the optimistic end, $9 trillion if you use the discount rate that any private sector pension fund would be legally required to use. For context, the entire federal debt that everyone actually argues about is around $36 trillion. So the pension hole is somewhere between 11 and 25% of that. Except unlike the federal debt, which at least gets counted, the pension hole is largely invisible. It lives off the books, in footnotes, behind assumptions, underneath numbers that were chosen specifically because they make the problem look smaller than it is. And the people who chose those numbers are the same people who would have to raise taxes or cut services to fix the problem if they admitted the true size of it. So they don't admit it. They haven't admitted it for 30 years. And in 30 years, the hole has gotten very much larger. This is the pension crisis. And it is not a crisis about retirees being greedy, or unions being unreasonable, or governments being incompetent, though elements of all three appear in the story. It is primarily a crisis about math, about promises that were made with other people's money, measured with assumptions designed to flatter, and pushed forward in time until the people who made them were long gone, and the people left holding the bill were the ones who had nothing to do with any of it. Let's start at the beginning. Because to understand how we got here, you need to understand how public pensions are supposed to work and how they actually work, and why those two things diverged roughly around the time that disco was popular and never really came back together. A defined benefit pension is a promise. A government employer, a city, a state, a school district, promises its employees that after a certain number of years of service, and upon reaching a certain age, they will receive a guaranteed monthly payment for the rest of their lives. The amount is defined in advance. It does not depend on market performance. It does not depend on how well the pension fund's investments do. It is a fixed obligation. The employer guaranteed it. The employees structured their entire career around it. To fund that promise, the employer sets aside money every year into a pension fund. That fund is invested, typically in a mix of stocks, bonds, and alternative assets. Over time, the investment returns are supposed to compound and grow the fund to a size large enough to pay all the promised benefits when they come due. The whole system works if two conditions are met. First, the employer actually makes the required contributions every year. Second, the investment return assumptions the fund uses to calculate how much needs to be set aside are realistic. For roughly the first half of the 20th century, this system worked reasonably well. Governments made their contributions. Investment returns were roughly in line with expectations. Retirees collected their pensions. Nobody panicked. Then came the 1970s and 80s. And a very human temptation entered the picture. The temptation worked like this. Public officials had to balance budgets every year. Pension contributions were large line items. Cutting those contributions freed up money for other things, like tax cuts before elections or services that constituents could actually see and feel. And the consequences of underfunding a pension didn't show up for 20 or 30 years, which meant the official making the cut would be long retired themselves before anyone noticed the damage. So contributions got cut, not eliminated, just trimmed, quietly, consistently, year after year. And the gap between what was promised and what was funded started to grow. But here's the mechanism that turned a manageable problem into a catastrophic one. The discount rate. When a pension fund calculates how much money it needs today to pay future obligations, it has to estimate the future value of current assets. The rate it uses to make that calculation is called the discount rate. And the higher the discount rate, the smaller the calculated liability looks today. A fund that assumes it will earn 8% annually on its investments needs to set aside far less money today than a fund that assumes it will earn 4%. Because in theory, the higher returns will make up the difference over time. Public pension funds in the United States have historically used discount rates of 7 to 8%. Some still use 7.5%. The reason is not primarily because fund managers genuinely believe they will earn 7.5% annually forever. The reason is that using a lower, more realistic rate would force governments to acknowledge a much larger unfunded liability, which would force them to make much larger contributions, which would force them to raise taxes or cut spending, which nobody with an election coming up wants to do. Private sector pension funds, by the way, are required by law to use discount rates tied to high-grade corporate bond yields, which in recent years has meant discount rates closer to 3 or 4%, which is why private sector pensions show much larger liabilities relative to their assets, and why most large corporations have spent the last 2 decades aggressively moving employees off defined benefit pensions entirely. Public sector funds operate under different rules. Rules they largely wrote themselves through the political process. And the rules they wrote allow them to use assumptions that make the math look better than it is. Here is what the math actually looks like when you use realistic assumptions. The state of Illinois, using its own official numbers, has a pension funding ratio of about 55%, meaning it has about 55 cents for every dollar of promised benefits. Using a more conservative discount rate closer to what private funds use, that number drops to somewhere around 30%. Illinois has roughly 30 cents for every dollar it has promised its retired teachers, firefighters, and state workers. The state constitution of Illinois, by the way, explicitly prohibits reducing pension benefits. So the promise is legally protected and mathematically unfundable at the same time. Illinois is not alone. Kentucky's pension system for non-teachers is funded at roughly 16% under certain calculations. New Jersey has been chronically underfunded for decades. Connecticut, California, Pennsylvania. The list of states with serious structural pension problems is not a short one. And this is before you get to cities. Detroit declared bankruptcy in 2013, partly because its pension obligations were consuming an unsustainable share of its budget. Chicago's pension funds have been in various states of crisis for years. Puerto Rico's pension system was essentially insolvent before the broader debt crisis that consumed the island. Now, here's where the average person, the one who has never worked a day in the public sector and has no pension of their own, might be tempted to check out of this conversation. Because so far, this sounds like a problem for governments and retirees and actuaries to sort out among themselves. It isn't. And here's why. When a pension fund runs short of money, there are only a small number of ways to close the gap. You can increase contributions, which means raising taxes on the people who live and work and pay taxes in that jurisdiction. You can cut benefits to retirees, which in many states is constitutionally prohibited and in all states is politically explosive. You can increase investment risk in the fund, which is what many underfunded funds have already done, shifting into private equity, hedge funds, and alternative assets in search of the higher returns their discount rate assumptions require, taking on more risk to chase a number that justifies the assumptions rather than adjusting the assumptions to reflect reality. Or you can cut other services, meaning schools, roads, libraries, public health, infrastructure, the things that make a city or state functional and livable, get hollowed out to make pension payments to retirees. And in city after city, that last option is exactly what has been happening. The share of municipal budgets consumed by pension and debt service payments has been rising for years. In some cities, it now consumes 30, 40, even 50 cents of every dollar the city collects in revenue, which leaves the other half to run everything else. Every pothole that doesn't get fixed, every school that doesn't get updated, every social service that gets cut is partly a pension story. It just doesn't get labeled that way. Meet Robert. Robert is 41 years old. He rents an apartment in a mid-sized American city. He works in the private sector. He has a 401k that he contributes to inconsistently, Because after rent, groceries, and health insurance, there isn't always a lot left. He has never worked for the government. He has never been a member of a union. He has never negotiated a pension benefit or voted on a collective bargaining agreement. But Robert pays property taxes, directly or through his landlord. He pays state income taxes. He pays the various fees and levies that fund municipal services. And an increasing share of every dollar he pays in those taxes is not going toward services he receives. It is going toward pension obligations that were incurred before he arrived, structured in ways he never approved, measured with assumptions he never scrutinized, and made legally untouchable by constitutional provisions he never voted on. Robert is not unique. Robert is most people. And the pension crisis, when it fully arrives, will land on Robert with significant force. Not because he made any promises, but because he's there when the bill comes due and someone has to pay it. The investment risk piece deserves more attention than it gets. Because underfunded pension funds chasing returns is not a small or theoretical risk. It is an active and growing one. Public pension funds have dramatically increased their allocations to private equity, infrastructure, and hedge funds over the last 2 decades, precisely because these asset classes offer the possibility of returns high enough to justify their discount rate assumptions. The average public pension fund now holds somewhere around 30% of its portfolio in alternatives, up from nearly zero in the 1990s. Private equity in particular has absorbed an enormous amount of pension capital, and private equity's returns over the full cycle including fees have been the subject of genuine academic debate. Some studies show meaningful outperformance versus public markets. Others, adjusting properly for leverage, illiquidity, and fee drag, show the outperformance largely disappears. What is not debatable is that private equity valuations are marked quarterly by the fund managers themselves, not by public markets. Which means pension funds holding large private equity allocations are partly measuring their own health, using numbers supplied by the people who have a financial interest in those numbers being high. It is, in a smaller and more technical way, the same basic structure as the pension accounting problem itself. The number is chosen because of where it needs to land, not because it accurately reflects reality. And the next serious market downturn will test this in ways that will be uncomfortable to watch. When pension funds need to meet benefit payments and their private equity holdings are locked up in 10-year funds with no liquidity, the math gets very difficult very quickly. When asset prices fall and discount rate assumptions still require 7.5% returns, the unfunded gap does not just grow linearly, it compounds. None of this means the system collapses tomorrow. Pension crises tend to move in slow motion. They build over decades, they accelerate during recessions. They get papered over with short-term fixes that push the problem forward. They arrive, when they arrive, not as a sudden crash, but as a long, grinding deterioration of services, creditworthiness, and quality of life in the places most exposed. Some things are worth knowing as this plays out. First, check your state. The funded status of every major public pension system in the United States is publicly available. Some states are genuinely in reasonable shape. Wisconsin is nearly fully funded. South Dakota, Tennessee. Others are structurally insolvent by any honest accounting. Knowing which situation applies to where you live, work, and pay taxes is genuinely relevant information. Second, the pension burden affects municipal bond risk. Cities and states with large unfunded pension liabilities are increasingly being priced as higher credit risks by the bond market. If you hold municipal bonds for tax advantages, the pension status of the issuer matters more than it used to. Third, property values in heavily pension-burdened cities face a structural headwind. When more of a city's budget goes to pension payments and less goes to services, the city becomes less livable, which eventually gets reflected in property values. This is a slow process, but it is directional. Fourth, the political resolution of this crisis, when it comes, will involve some combination of tax increases, benefit cuts, and service reductions. Which of those three bears the most weight will be determined by who has political power when the moment of reckoning arrives. That is worth paying attention to. Fifth, Your own retirement planning cannot assume that public institutions will solve this cleanly or quickly. The trend in the private sector away from defined benefit pensions toward defined contribution plans like 401ks is partly a response to exactly this risk. The employer doesn't want to hold an obligation it can't guarantee. That logic applies to you as well. The pension crisis is not a story about greedy retirees who worked their whole lives expecting a promise to be kept. Most of them held up their end of the deal. It is not a story about evil politicians, though short-sighted politicians made it much worse. It is a story about a system that was structurally designed to make the problem invisible until it was too large to solve cheaply. A system where the people who made the promises faced no consequences when the math stopped working. And a system where the eventual cost will be distributed among people who had nothing to do with any of the decisions that created it. The math does not care who made the promises. It only cares who is there when they come due. So here's where I want to hear from you. Do you think the pension crisis gets resolved by a wave of municipal restructurings and benefit cuts that finally forces the math to balance no matter how politically painful? B. Federal intervention that essentially socializes the problem and spreads the cost across all taxpayers nationally? Or C. A slow grinding deterioration where nothing officially breaks but services quietly disappear, and the people least able to absorb that bear the most of it? Drop your take in the comments, because where you land on this one probably says a lot about whether you think institutions fix themselves or whether they just find new ways to push the problem forward.